So I guess welcome everybody. As kind of Nick says, we really did have a great panel this morning, private equity breakfast. I guess I'll just give everybody a chance to introduce themselves. Starting with Anthony.
Sure. Anthony Palazzi.
Anthony Palazzi, Managing Director at Sun Capital Partners. I've been with Sun for about 11 years now. The firm is a private equity firm with about $10 billion of capital under management, focused on the middle market, on businesses across industries, that we can use our operational expertise to help get on the right track and help grow.
Roman Krislov from HIG Capital. We are Miami-based. We were founded 20 years ago across the street with a little $75 million fund on Brickell Day Drive. So fast forward 21 years, we have $17 billion of equity under management. We're the largest middle market focused private equity firm in the country and the most active just in terms of deals done. And we look for opportunities to differentiate ourselves. And so we're quick studies on a number of different businesses. We have 80 portfolio companies representing about $30 billion of revenue. Everything from prison software to packaged lettuce to if you guys ever go to Hooters, that's one of our portfolio companies. So thank you for your sponsorship. And we're thrilled to be here. Thanks.
I'm Lars Johansson. I'm with Blue Mountain Capital. We're actually based in New York, so I learned this morning I'm token out of towner. But we're about 50 investment professionals, 14 billion in assets under management. Middle market, growth-oriented investors fundamentally, so invest in distribution and logistics, healthcare, software, information services, with sort of a good to great strategy looking for leading companies in good sectors where we can hopefully bring some value to the table ourselves and help grow the business. We actually have two companies down here in South Florida, a business called Valley Waste over in Tampa, and then Paul's business in San Diego.
Sherman, CFO of ABB Optical Group. We're the nation's largest distributor of contact lenses and optical products to eye doctors, chain stores, hospitals around the country. I've been at ABB for 5 years. At the time I joined, we were about 300 million in revenue, and today we'll exceed $1 billion. It's 2 years to the day since we closed our transaction with New Mountain, and New Mountain is the third private equity group that I now work with.
I'm Chip Vandenberg. I started out with KPMG, had about 10 years with them in New York and Miami, joined TriVest 28 years ago, so I've been there a while. First 12 years I ran 25 companies on the C-level, and since then I've been one of the senior partners. We're sort of the small guys in the group here. We have a $415 million fund currently that we're investing. Our focus is solely on family founder-owned businesses that need a transition, and with 10,000 baby boomers retiring every day, and they control 80% of the companies under 200 million. We've been quite busy. Great, thank you. So I guess to start off, I was reading a recent deal study saying there was an increased number of deals from 2013 to the first quarter of 2014, and then since then it's been declining again, been a downward trend. I was just wondering how you guys kind of saw the market these days, what's going on out there. Roman, do you want to say?
Sure. So I'd say the private equity market is probably not unlike the Miami real estate market right now. I mean, it's as hot as it's ever been. I think prices that people are paying are as high as they've ever been. I think there's probably a little bit more discipline similar to Miami real estate, where you're not seeing the 5 or 10% deposit, apartments going in, and now you're seeing similar prices, but if you want an apartment at the SLS, it may have to run you a 40 or 50% deposit. So I think you're seeing a little bit more of that. I think the lenders are as aggressive, but it's a little bit more discipline, a little bit more equity. And so I think that's probably good for the market. Look, if I was a business owner, I would seriously be thinking about selling right now.
It would be about $50 million deal. $5 million would normally go into escrow. The cost of the insurance is 3%, $150,000. We split that with the seller. And then they have a deductible, on that case, about $250,000. And we also split that deductible with the seller. And what happens is the insurance company comes in, basically piggyback our due diligence. We know the form that they're using now, so over time it's developed into a pretty set form. And we set up the purchase agreement with that form in there, and it covers both the seller and the buyer, except for fraud. If there's fraud involved, we're not going to cover it.
2013, there were 750 intermediaries, brokers, investment banks that closed deals. 75% of those closed 3 deals or less. And so while the big mega deals and the big hotel chains and the big fast food companies that ended up selling, like Burger King around the corner, those go through big investment banks. Our bread and butter is the small business broker, maybe the wealth management advisor, and we want to be on a short list.
I agree with everything that's been said. I think it's customized. Each company is different, and each company has a different set of circumstances, and so you'll pursue an exit. There are different strategies around exit with different companies, but maybe just a pulse point on the strategics. I think the other thing to note there is you do have to be prepared to field more opportunistic type inbound calls or situations, because strategics, can't always move as quickly in processes, and often they have their own outside factors that are contributing to whether or not they're prepared to make an acquisition. And so I think particularly in the case of strategics, we have to be a little bit nimble as sellers, where we think a strategic is the best buyer, so that we're prepared to meet their timing and can be in the market at a time when they're actually ready and feel confident to make an acquisition.
I would have one more comment too, is that we tend to lump strategics as a group, but there's a very big difference between a U.S. corporate company and a Chinese strategic.
And there's always the mythical all-cash Chinese or Russian buyer that comes in and says, I'm going to pay you X amount for whatever, and it just doesn't happen. I mean, 99% of them, it doesn't make any sense. I mean, it's similar to Miami real estate, with it's all mythical, I don't know where all this all-cash South American money comes from. But these buyers really don't exist, and it's too good to be true. It typically is.
What I'm trying to get to is the notion of making an investment. You believe in the management team, but you don't necessarily have absolute control over the destiny of the company. If you're in that situation, how do you think about it? How do you protect yourself? And then how does that change the profile of the investment?
In most situations, we're a control investor, but I'd say the typical profile of our deal is where we'll own somewhere between 55 and 75% of the company, and then a management team or a founder is invested alongside us with a big chunk. But we have done minority deals, and in those situations, it's just about setting up the right governance structure so that we're comfortable. There's clear alignment around the ultimate exit for the company and what the plans are along the way.